Good morning again, and welcome to Real Estate Economics webinar series. This week we're covering the state of Texas. This is part 3 of 4. If you'd like to view the whole series, please make sure you catch all 4 parts. This particular section will be covering home prices, valuation, and taking a look at our opportunity risk report. Median home prices for the state of Texas remain highly affordable. Those of us in California are always stunned by how great the values are here. There was a couple of periods in this particular area and across the state where home prices ran up at fairly high percentage figures, 2004 through 2007. We've had a little bit of backtracking here, obviously, into 2010. Although the numbers, the percentages are decent, the numbers are fairly small. And over the forecast period, we're going to gradually go back to new highs. It seems a long ways off, but by 2013 or 2014, we're expecting that the job growth will start to gradually fill in and prices will remain affordable. More people will be able to get into houses here, and we'll be able to recover some of the price damage that's been done during the past several years. Again, nothing like what's transpired in Las Vegas and Phoenix, where we've had huge losses in value. Here's the change on an annual basis. As you can see, after 1990, this market performed very well. Annual appreciation really in the 3, 4, 5% range, with some high numbers in 2005 and 2006. We generally don't consider this market to have experienced, at least on a state basis, the same sort of bubble that we've seen in many parts across the country. The numbers are elevated here, but the magnitude of the overvaluation isn't nearly as severe. By 2008, that appreciation starts to taper off as the economy weakens, and then we've got a relatively minor loss in 2009, accelerating into 2010 at 3.6%, and coming back to just 0.2% for 2011. So we've got really 3 soft years with some below trend years on both sides in 2008 and 2012. Gradually, appreciation will revert towards the mean here, up to 3.2% by the end of the forecast period. In many places we've seen, obviously much larger losses, but not that strong a rebound. So in total, in aggregate, this market's performed fairly well. This is our graph of housing valuation patterns for the entire state. The blue line is historical or forecast for the forecast period, median home prices, and the green line is supportable median home prices. And that supportable number is calculated using median household incomes and current interest rates. So we can calculate what type of home value the median income can afford in this particular area. As you can see, from 1990 through about 2006, these lines tracked fairly consistently. There's a little bit of movement as the jobs oscillate, as we've mentioned in the previous slides, and we start to see some more pronounced overvaluation in 2006, which would associate with the subprime, although not quite as severe here, when all of a sudden people can get a loan for more house than they can afford. The only way for that excess purchasing power to manifest itself is through higher prices. So essentially, home prices were able to become detached from incomes at that point in time. That excess demand just translates straight into larger and larger numbers for these homes, even though the supportable didn't really move that much. If you look into the 2009 time period, there's a sudden large increase in the supportable median home price. That is the point in time where the interest rates were cut from about 6 to about 5, making it possible for the median household income in this area to afford much more house. Obviously, this is a response to a recession and poor economic conditions on the ground, but the spread here in the forecast period between the supportable median home price, and the forecast median home price suggests a period of fairly pronounced undervaluation for housing in this market. Houses are very cheap. If you have good job prospects and you think you can be employed for a few years, it's an excellent time to buy a home, in our opinion, or at least based on this metric. Homes are relatively cheap compared to long-standing, time-tested ratios between price and income. Now here's another measurement on the over and under valuation, where we can put this into dollars. As you can see, through most of time from 1990 to about 2005, the over or under valuation is fairly restrained, just really oscillating up and down with employment conditions, and during periods of high employment the market can become a little bit overvalued and so forth. As we get into the recession, now all of a sudden homes are undervalued. When the rates move down, people could afford more, and you can see during the forecast period, throughout the entire forecast period until 2014, homes are consistently undervalued. This is manifesting itself in a number of ways. We see many adult parents offering down payment support to their kids. There's rental investors and flippers and remodelers active in most markets we work in. They've been in the market for years. Many are experienced professionals, and they recognize the magnitude of this undervaluation, and they're making home purchases, really culling through REO and shadow inventories, looking for the best units closest to schools, closest to employment, and they're acquiring those units and putting them into their portfolio for future sale. This is our residential opportunity risk report. Covers the economic factors that go into housing in Texas and all the other markets we serve. On the left-hand side, you can see the housing demand. We've talked to this a little bit as it relates to employment and how employment really drives those demand numbers. And the next column is supply. We've talked to that, how that grows relatively slowly. In the red numbers in the third column, we define whether or not the market is over or underbuilt, and presently we're defining it as overbuilt, not due to a bunch of construction or speculative building of subdivisions or anything like that, but really a function of weak jobs and having the job base be too small for the existing housing stock. Moving over one column, you can see the median home price with a couple of years of decline, but a little appreciation coming up in the later in the forecast period, and we calculate an equilibrium home price. I think the interesting thing here in the equilibrium home price is from 2011 through the forecast period. That equilibrium home price is actually declining, and that is a function of interest rates increasing while household incomes remain relatively moderate. It's going to make that house a little bit more difficult to afford as the rates climb, which you can see in the 30-year mortgage rate column. And you can also see the median household income, which we talked to earlier, growing fairly steadily. Then we talked to whether or not the market is over or undervalued. Now, based on those interest rates and the current household incomes for 2010, this market is undervalued and will remain undervalued in 2011 and 2012 before finally reaching a little bit more of an equilibrium condition between 2013 and 14. Overall, on the right-hand side of the chart, this particular state has been in a fairly stable condition with some minor oscillations up and down, but overall the experience here has been fairly good. Employment is not as weak as most parts of the country. Appreciation was not as pronounced as many areas, and that's allowed the housing market to stay in some general order, at least compared to much of the nation and the hotbeds of subprime. That's the end of part 3. If you'd like to view all of the webinar today, please make sure you get all 4 parts.